How much did you retire with? Is it risky to hold a lot of covered call funds that pay 8 to 12%? How did you transition from growth to income investing? These are some of the questions I'll answer in today's Q&A. Let's start with a juicy one. How much did you retire with? I appreciate this question because I'd wonder the same thing if I saw somebody retire and they didn't look old. I don't know about you, but I don't ask my friends or family how much they have in the bank or what their net worth is, so I definitely couldn't ask a stranger that question. But there are some people on social media that want to share that type of information, so I can see why it comes up these days. This channel is about sharing what I learn about income investing. After a while, I also opened up about what I buy, sell, and hold in my portfolio. I think that's a relevant disclosure, and there's not much downside to me for sharing that information, but that's about as personal as I'll get. Let's shift away from me and toward answering the question in a way that's helpful to you. I think the question they're really asking is, did you do anything special that allowed you to retire early? My original plan was to retire to a beautiful part of Australia called the Sunshine Coast. I invested in growth stocks and real estate and was just trying to build the biggest nest egg I possibly could, like most people. Then I was going to follow the 4% rule, which means selling a small part of the nest egg each year to pay the bills. That plan required a lot of money and was going to have me retiring about 10 to 15 years later than I actually ended up doing it. Also, there was no guarantee it would work. I needed my real estate investments to keep going up in value. I needed my stock portfolio to keep going up in value. And the property I wanted to buy on the Sunshine Coast, I needed that to stop appreciating so quickly so I could catch up. Instead, I chose a path with more certainty that allowed me to retire back in 2017. So here are the steps that I took. Number one, I ditched the 4% concept and switched to income investing. So instead of selling stocks to pay bills, I hold income investments and only spend the dividends. I also reinvest some of those dividends to keep the income growing. My portfolio yields about 11% at the moment, and there's a link in the description if you want a copy of it. It's called Armchair Insider, and it's free. Number two, I moved from the US to Southeast Asia. The primary reason is that I just love living here. The other benefit is the low cost of living. There are other options, of course, in Central and South America and also in Europe, but this is the one that works for me. Number three, I rent my home. After a career working in commercial real estate and investing in residential real estate, I'm very familiar with the financial pros and cons of owning a home. There's also some lifestyle considerations. In some areas, maybe what you want isn't available for rent, so the only way to have it would be to buy it. I chose to invest the money that I would have spent on a home, and putting that capital to work produces far more cash than the cost of my rent. In some countries, renting comes with a bit of a stigma, but I don't really care, and I don't live in one of those countries. Number four, I have no debt. That one's pretty self-explanatory. As for the math of how much money is required, I added up my annual living expenses, or at least what I expected them to be, and divided that number into 6% and 7%. I knew income investing could comfortably exceed that 6 to 7% range. The number that I came up with was what I needed to retire. As I mentioned earlier, my portfolio generates about 11%. But when I retired, I was new to income investing, so I wanted to be fairly conservative. Now that I'm comfortable with it, I spend more like 8%, and then I reinvest the other 3% so that my income continues to grow. If I had to live on 6 or 7%, it would be fine. I'd just travel less. The irony to this story is that after retirement, I had the time to go and do an extended trip to the Sunshine Coast in Australia, where I was originally planning to retire. I went for a whole month, and even though I still enjoyed it, by the fourth week, I started to get a bit bored. So that actually confirmed that I'd made the right choice. Covered call index funds seem ideal for an income investor. Typically, they offer the diversification of an index like the S&P 500, and they deliver regular income. For example, SPYI yields around 11 to 12%, and the monthly payouts are quite consistent, as you can see here. This distribution chart came from Snowball, which I also use to keep track of my income. I was trying to do that with my brokerage accounts, but they're not really designed for income investors. So I entered the holdings from my 3 brokerage accounts into Snowball, and now I can see the big picture in just a few seconds. I can rank my portfolio by current yield to see if there's something I want to sell. I can check the yield on cost, and most importantly, I can see a calendar that tells me how many dollars will arrive on any given day of the month. There's a link in the description for a free trial and a discount. All this income from a fund like SBYI would be useful to pay your bills in retirement, so why bother with anything else? This question asks how much to allocate to covered call ETFs. Well, my portfolio is currently weighted at about 24% to various covered call funds, about 7 of them at the moment. I'm not suggesting you should copy that. That's just where I'm comfortable, given my age, my appetite for risk, and my willingness to keep track of more than 30 income investments. I want to approach this question by explaining why I don't allocate everything to these 7 funds, or at least a lot more than I do. Although it would make life a lot easier if that were the case, I wouldn't have to worry about the other 30 investments that I'm holding. There's no free lunch, and covered call index funds, just like every other asset class, have their pros and their cons. I've already mentioned the pros, which are diversification and consistent income. So what are the downsides? What's the risk? The most commonly quoted downside is that during a bull market, these funds will underperform the underlying index, remembering that these funds effectively sell some of their upside in exchange for current income. So if the S&P 500 had a huge month and appreciates, say, 6%, and an S&P 500 covered call fund sells options at 4% above market price, it's given up its right to the difference between the two, which in this example would be 2%. The good news is that it receives and passes on income for doing that, let's say about 1% per month. But a 4% gain plus 1% income adds up to 5%, not the 6% achieved by the S&P 500 in that example. Another scenario that's bad for a covered call index fund is a major sustained correction, one that lasts more than a couple of months, followed by a rapid recovery. In that scenario, the covered call fund would fall with the index. It would fall by the same amount, but it wouldn't recover as quickly. On the other hand, if the market bumps along sideways for, say, a year, a covered call index fund can outperform the index. In that scenario, neither the index nor the covered call fund would experience any appreciation, but the covered call fund delivers a lot more income. One last point, there's an important distinction to understand about any fund that uses a financial instrument to generate income from a portfolio of financial assets. This includes covered call funds like SBYI or HYBI, or funds that use futures contracts, because those are financial instruments as well. An example would be SVOL. The income is a function of the fund's assets. So if the assets shrink for a sustained period, so will the income. Remember that for an ETF, the assets of the fund are equal to the current price of the fund. By contrast, most other publicly traded investments generate income independently of their price. For example, if the price of Coca-Cola stock falls, that doesn't make it more difficult for them to generate earnings by selling drinks. Or if the price of a real estate fund like RLTY falls, that doesn't make it more difficult for the holdings in that fund to generate earnings by collecting rent from the buildings that they own. As much as I like covered call funds, I don't want them to dominate my portfolio. If market conditions are unfavorable for them, I want to have other income investments to smooth out the bumps. Most people shift from growth investing to income investing somewhere around retirement. This question is asking about the timing and whether to jump in with both feet. They also ask about being 100% focused on income versus a more hybrid approach. So let's start with the timing. I made the switch from growth to income investing right at retirement. It was a busy time finishing up my career, selling my real estate investments, moving to a new country, etc., etc. In hindsight, I'd say there are actually 2 benefits to starting a bit earlier than I did. Number 1, there's a steep learning curve. You can make growth investing pretty easy. You just buy VOO or SBY and you keep on buying it year after year, decade after decade. But for income investing, you need a lot more diversification, and each asset class is quite different. Covered call funds, business development companies, corporate bonds, all these things have different ways of making money and different risks to assess. So if you just sit down on your first day of retirement, sell all your growth investments and create a full portfolio of income investments, I think it's too much to learn. I would suggest it'd be better to start small and transition gradually. Also, if you could start at least a year beforehand, it would get you comfortable with the various types of income investments. Given that income investing is less tax efficient, I would suggest learning income investing with very small amounts while you're still getting a paycheck so you don't screw up your taxes. The second factor to consider is sequence of returns risk. That's not sequence like the shiny things that some people wear while they're singing show tunes, by the way. Sequence of returns risk means that if you happen to retire during a bear market and each week you watch your portfolio shrink more and more in value, the idea of selling those growth funds or stocks for any reason would obviously be quite painful. It's not realistic to time retirement to coincide with selling at the very peak of the market. So you could take some risk off by moving some capital out of growth a little bit before retirement, perhaps into bonds or something with low volatility. You would possibly miss out on some gains and you'd pay a little bit more tax, but at least all your eggs wouldn't be riding on the fate of the S&P 500. The third part of the question asks about being all in on income investing versus a more blended approach. That's a pretty long discussion. We're not going to get into details about that here. Even though I'm 100% in income investing, I don't claim it to be a superior strategy or the only strategy. I think my income approach can also be useful as a complement to other strategies like growth, dividend growth, 60-40 stocks and bonds. There's a lot of different options. You could allocate a little slice of a portfolio to income investing for the purpose of boosting your current yield by an extra 2 or 3%. I recently interviewed Garrett from NEOS about their new bond fund that yields 8.7%. The natural question is, well, are you going to buy it? The short answer is, I haven't yet. I'm open to buying it, but there's no rush. It's easy to get excited about new funds. I bought QQQI not long after it was launched, but that one is a covered call fund that uses exactly the same strategy as SPYI, a more established fund. The only difference is that it's based on the Nasdaq 100 instead of the S&P 500. HYBI is a completely new strategy, at least to me. It combines an actively managed high-yield corporate bond fund with a put spread options overlay. It's all explained in the interview with Garrett, but it does have quite a few moving parts. I'll give it some more time and keep an eye on the distributions, how the NAV behaves, and just generally the volatility of the fund. For comparison, I don't hold Nvidia stock, but if you get in late on a growth stock like that, you can miss out on some massive gains. But being late to a fund that's designed to produce consistent income with low volatility, not so much downside. There's no prize for being first in. This question comes up every time I review a BDC fund. People want to know why I'd buy anything with expenses that are so crazy high. I had the same reaction at first, and this is a confusing issue, so I'll explain it here. Business development companies offer yields over 8%, and some of them have long track records of success. There are about 50 to choose from, and it's a lot of work to pick the good ones from the poor performers. So one solution is just pay someone else to do it for you in the form of a fund. The biggest fund is BIZD or BIZD. It yields 11.5%, and the expense ratio is 13.33%. The fund I prefer is PBDC. It yields 10%, and the expense ratio is 13.94%. The reason these expense ratios look, frankly, ridiculous is an SEC regulation that requires funds like these two to include expenses from the companies held by the fund as part of their expense ratio. So, for example, BizD's largest holding is Ares Capital Corporation and is required by the SEC to include expenses from that corporation, as well as all the other holdings, as part of the expense ratio it discloses to investors. It's confusing, and it doesn't apply to funds that hold regular stocks. So an S&P 500 fund doesn't have to include Apple or Microsoft's expenses in its expense ratio. The money that actually goes to the fund is the management fee. That number is 0.4% for BizD, which is an index fund, PBDC is actively managed, so its management fee is higher at 0.75%. Unfortunately, you have to read the prospectus to find that number. I'll include a link in the description to a more detailed explanation of how these fees work. They're called acquired fund fees. On a brighter note, PBDC has delivered a total return of over 60% since its inception in 2022. If management was pocketing 13% a year, that obviously would be impossible. If you're trying to choose between PBDC's 10% yield and BizD's 11.5% yield, this analysis by the gaming dividend on Seeking Alpha is definitely worth a read. It's titled PBDC Eliminates the Unwanted Fluff. I picked PBDC a while back, but you might want to hold both. You can get all the basic financial data on free websites like Yahoo Finance, but that doesn't teach you how these investments work or make a case for whether to buy, sell, or hold them, which is what I get on Seeking Alpha. If you haven't used Seeking Alpha, there's a free trial and a discount linked in the description. I use it every day, and I'll also put a link into that article I mentioned. That's 5 questions. It'll be back to fund reviews and interviews in the coming weeks, but if you like this Q&A format, click here for other episodes just like it. More Armchair Income coming soon. Armchair Income.